Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. You got to get an audible questionnaire. Do this with Ivan Feinseth, perfectly timed, senior partner, grizzled veteran. First heard of him at Bear Stearns years ago. Tigress Financial Partners. Ivan, I got to go to SMCI. Hindenburg puts out a short report of his stock. 24 hours later, the company comes out with, oops, the 10K doesn't look good. What does the Feinseth radar say about SMCI going from Hindenburg tank to, oops, the 10K doesn't work?
Well, not good, but they recently switched in 23. They switched to Deloitte & Touche, so I guess they're going through the filings again to make sure that there are no issues. I mean, Hindenburg does have a short position in the stock, and then they do publish research that recommends that shorting the stock based on accounting irregularities. So, I mean, it is Hindenburg's work has been questionable. However, I do like Supermicro. It is part of the AI play. So I right now feel this weakness is a buying opportunity. And they are a tremendous partner with Nvidia, so to manage outsourced data centers. So hopefully there are no irregularities, and we look back and this will have been a buying opportunity.
You've been doing this forever, and you've got a wonderful skepticism built into your securities analysis. I got 66 buys, 8 holds, no sells on the juggernaut known as Nvidia. What does the Ivan radar say when you see everybody on board?
Well, I think back in the olden days, they used to view a lot of buy ratings as being a contrarian indicator. Yet it has not been the case with Nvidia. You can see on Bloomberg that my split-adjusted initial buy rating going back, I think, to 2015 is now like 50 cents. But Nvidia is at the core of this process of being able, originally they were able to take digital information and turn it into visual information at a faster level through their graphics processors. And now they are taking visual information and turning it into digital information, which is really the driver of this whole AI large language or machine learning process. I mean, that our brains are analog computers that see things and process visually and based on an analog basis. And to give you an example, a computer learning the difference between a cat and a dog is a visual process. And that's what NVIDIA is enabling these computers to do as we adopt AI to handle data processing.
So in terms of what NVIDIA needs to do today after the close, Ivan, I guess that has to be another beat and raise, or the stock's in trouble?
Absolutely. Well, first of all, there's expectations that the revenue will be up 70 to 80% year over year, and that earnings will be up almost 100%, and that they will guide higher again for the next quarter. And more importantly, there's been this controversy around whether the next generation processor, the Blackwell, will be delayed or not, which is kind of funny because they said it's coming, and they never gave a specific date. So I don't know if it's delayed if you don't really have a specific date. But it will be there'll be a focus on a discussion of when the Blackwell processor will start to ship, and they already have the next generation Rubin processor that they announced in March of this year that will come out next year. So they continue to make faster and more powerful processors and combining now GPU and CPUs. So the Rubin processor
Right.
is a major leap forward, and they continue to drive this whole process.
Ivan, do you believe, as others have said to us, that basically NVIDIA says you're not going to get the Rubin or the Blackwell unless you buy the present chip, and that they're basically almost creating a luxury stock scarcity by saying you don't get the 2026 chip unless you load the boat with a 2024 chip? Is there veracity to that?
Well, they control the market, and there is a huge demand for processors. Even the CEO of Supermicro, who's friends with Jensen Huang, continues to ask him for more and more chips. You have Mark Zuckerberg at Meta asking for more and more processors. There's huge demand, and the data centers are being built based on each level of processor while you're building out the current processor based on the Hopper, which is the current processor. Then it'll be followed by the Blackwell. NVIDIA has to, like any company, take care of their best customers first.
Hey, Ivan, a very intelligent investor asked me earlier this morning, why aren't some of these other chip companies more competitive with NVIDIA? Why does NVIDIA have such a strong position in this part of the market?
Because they're multiple steps ahead of everybody else. And, the quote, while everybody's playing checkers, Jensen Huang is playing 3D chess. So they pioneered the graphics processor and invented it, from the beginning, have pioneered it and continue to leapfrog and be just way ahead of anybody else. So, and if your business is dependent on this, like the hyperscalers and the cloud service providers businesses are, you want to go with the best, the most reliable, the fastest. And even Jensen Huang has said, the more you spend, the more you save. So it also has the cost in processing does present a saving. So that is a factor there too.
Ivan, thank you so much. I really appreciate the comments on SMCI as the news breaks of questions over their 10K filing, and Mr. Feinseth mentioning Deloitte Touche involved there as well. Ivan, don't be a stranger. Thank you. With Tigress, just incredibly well timed. Marilyn Watson is at BlackRock.
Yep.
She got a fancy title. She demanded this title when she came over from JP Morgan, Global Fundamental Fixed Income Strategy. Here's what you need to know. Tour duty at her Bank of England, and also a parchment from the University of Cambridge. Marilyn, I'm dying to talk to you about what I believe is a reset after the Powell speech. When I look at full faith and credit yields today, it just looks like a massive, dare I say, permanent reset to lower yields. Do you buy that idea?
Well, I certainly agree that we have seen a big reset in terms of the pricing, obviously for treasuries, but for fixed income as well. When you look at the roller coaster that fixed income yields have been on, prices have been on this year, from pricing at the beginning of the year to then a lot of cuts, then at one point even pricing a further hike. And now I do think, finally, after Powell's speech at Jackson Hole, then the scene is definitely, set for the Fed to start cutting rates in September. I think when you look at yields, when you look at also all-in rates, I do still think in this environment, while we do think obviously the Fed will cut in September, and they will continue to cut perhaps for the next few meetings. Powell made it very clear. He said that the direction of travel is that rates will be going down. When you look at the all-in yields that you can also get in credit and elsewhere, then they're still very, very attractive. I think particularly when you look at an economy that is still pretty robust. When you look at, obviously, the labor market is softening, and the Fed has sort of pivoted now from focusing on prices to focusing on the labor market and the overall growth of the economy. It is softening, but the US economy is still, at this point in time, still doing pretty well. So I think we have seen a big shift. We've seen a shift towards seeing lower rates commencing next month. But I do still think that now we can continue to see very attractive yields in fixed income.
Marilyn, what do you expect from our European friends? The ECB and the Bank of England have already begun cutting rates, and will they take a little bit more confidence to continue that trend, given that we've heard Fed Chairman Jay Powell say that the U.S. Fed is ready to start cutting rates?
Yeah, that's right. So they both already began to cut rates. Obviously, the Bank of England cut them at the beginning of this month, the ECB a little bit before that. And we think that they're going to continue to cut rates, but probably in a little bit more of a gradual fashion, probably about once a quarter. So we do think in September that the ECB will cut rates again. Obviously, at the end of this week, we do get the flash HICP, the inflation data coming out of the Eurozone. We think it's going to keep them on track to cut rates again in September. In terms of the Bank of England, we heard from Governor Andrew Bailey also at Jackson Hole, and he was also very clear that the direction of travel is that rates will probably go lower. But again, he's in no hurry, and we do think that it will probably also around once a quarter. So we expect that the Bank of England may cut rates again in November. I think when you look at the starting point, as you say, both the ECB and the Bank of England already started their easing cycle. The Fed, I think, has a little bit of catch up to do. It's obviously a bit later than them. And so we do think the Fed may be a little bit more aggressive in terms of the next few cuts, whereas the Bank of England, the ECB will be more gradual. And also their economies are in a different place to the US as well.
All right, Marilyn, so you're at BlackRock. You guys are everywhere. Given that backdrop of global rate declines, where do you guys see value these days?
Yeah, so when you look at government bonds, first of all, then we still like some Spanish duration. We're also long UK duration, a little bit in the US. And then we're short duration in Japan because, we do think that, the Bank of Japan is actually going to continue to hike rates this year. But we do like, at the front end of the curve, we do like attractive names in investment grade credit. In Europe, in the Eurozone, for example, we still think that you can find some very attractive all-in yields and some very attractive valuations, particularly when you then hedge that back into the dollar. We think that's pretty attractive in many cases. We continue to like some securitized assets, some very liquid, very cash generative names as well, where we think, you get decent yield, a decent all-in carry, but you also do have, I think, a lot of flexibility. And where we are now, we want to make sure that we really understand on a risk-adjusted level.
Right.
We also do like areas of emerging markets. For example, we're long Mexico still too.
Marilyn, we got to be quick here, but this is too important. Yeah. I just put on Twitter my Marilyn Watson chart of the day. I'm going to discuss it, Marilyn. This is an adult chart. It's Global Wall Street Talk, folks. Stay with me. Marilyn, I went back to Paul Volcker, and I looked at the Bloomberg Corporate Total Return Series, not full faith and credit. And I took the regression from 1990 out to the present day. The bond debacle that you and BlackRock have lived was a 3 standard deviation move. Really elegant. The fact is, with a Powell speech, I'm back to a -2 standard deviations. Can you envision price up, yield down, where we could get back to 20 and 30-year log trend on the price of bonds?
So I think when you look at the corporate market, I mean, we certainly could expect to see yields come a little bit down from here. I certainly think that's possible. I think also when you look at the overall economy, when you look at what is being priced in terms of the sheer number of cuts, first of all, by the Fed, the market's actually pricing in a lot of pretty negative news that we don't necessarily see coming through next year. We do think the labor market will continue to soften. We do think activity will continue to soften, but we don't see a strong catalyst certainly for any sort of sharp recession or anything like that.
Right.
So when you look at the overall backdrop in terms of corporates, when you look at particularly in the US as well, we do continue to see a pretty strong backdrop in terms of economic activity, one that is slowing. But again, we do think yields will come down.
Okay.
We do think that prices, however, will remain pretty attractive.
This is a clinic. Marilyn Watson, thank you so much. Greatly appreciate it with BlackRock. Emily Roland joins from the John Hancock Company with the clarity of her belief. Emily, you have nailed Buy American, Buy Mid-Cap. Do you still believe that?
Yeah, we do, Tom. And the way we think about this is you want to identify where are the best earnings trends and where are the best economic trends. It's as simple as that. A lot of people will tell you that valuations are the key input. For us, we want to look at the denominator of the PE ratio as the key here. And the US has simply been able to generate better earnings results. Just this year, we're looking at about 11% in the US versus about half that in international markets. High quality stocks, guess where you find those? In the United States. Those are ones with great balance sheets. They've got tons of cash. They're going to do a better job defending their margins in an environment where the late cycle dynamics continue to play out.
Very quickly, our SMCI opening here at 9:32, Paul. I'm going to go back 4 days before the Hindenburg news, down 21% from where it was August 23 into a Friday of last week. Right now, 471, worse than it was pricing before the market opened.
Absolutely. Tom, all right, thank you for that. Emily, we just finishing up earnings period here. What did you take away from the earnings cycle and maybe the guidance that we saw from some of these companies?
Yeah, earnings this quarter, of course, much better than expected. Of course, we have a behemoth after the close today, which is going to be highly influential. Hard to forget that that's coming later on today, but better than expected. Technology in particular saw about double the earnings growth as the broad market. So I think, there's so many smoking guns out there that investors are pointing to as negatives. You look at some of the economic data that's coming in worse than expected. You look at especially the labor market data, which is showing some cracks. Earnings is not one of them. The earnings backdrop has been robust. And again, that's a key reason that we've continued to emphasize U.S. equities given those positive earnings trends.
So we heard from the Fed chairman on Friday pretty clearly looking to cut rates there, assuming that actually takes place here, maybe beginning in September. What sectors screen well for you in a market where, earnings, the rates seem to be coming down?
Yeah, I think, the Jackson Hole speech, by the way, was pretty interesting. We saw exactly what was expected. Powell obviously confirmed that cuts are coming. But I always watch the market reaction. And, we saw bonds move a little bit. Market expectations of a rate cut didn't change really. 100 basis points penciled in for this year. But we saw huge moves in equities and in currencies with the dollar plunging to near 2-year lows. So I think it was a big sort of sentiment driven move there as nothing to me really seemed to change in terms of the expectation. So I think that was notable. In terms of sectors and parts of the market that we think should do well, it's sort of the opposite of the market reaction that we've seen with areas like small cap value stocks doing the best since that day. Areas like international value stocks, which have benefited from that weaker dollar. We actually think that the Fed is probably going to be cutting because something's wrong. Maybe it's as simple as margins are getting compressed and the unemployment rate's going up. Growth is slowly slowing. So in that case, cyclical assets wouldn't be rewarded. This is like the secret life of asset allocators and the way that we think about these cross asset moves. It doesn't really make sense. You have this odd kind of partnership right now of long dated treasuries and gold in international value and small cap stocks being the best performing things out there. It actually doesn't really make a ton of sense when you open up your textbooks.
Emily, Roland, stay with us. Don't go away. We've got to follow SMCI where they're having 10K issues. Thank you, Ivan Feinseth, for perspective here moments ago. Opening, can't find a bid. It was a 550. And it's now 459, 459 off of where it was 614 a couple days ago before the Hindenburg short report. It is down 25%. Still can't find a bid, 456 right now. Emily, Roland, when we look at the market, and this is something you can do from old John Hancock or new John Hancock in Boston, you can say, when does the money move? Are we getting near a yield? As we see 30-year mortgage down, are we getting near a cash equivalent out 3 months or 2 years where we see money supporting equities?
Yeah, I think we're there right now. One of the, we think about these sort of timely indicators in the markets that we watch. And right now, to us, it's really about initial jobless claims and high yield bond spreads. Initial claims, they picked up a little bit last week. They're still in this range of 200 to 260,000. High yield bond spreads extremely tame at about 310 basis points over treasuries. That's well below the average over the last 20 years of 500 basis points. So I think until you see movement on that front, I think markets are going to continue to reward equities. We want to think about, again, leaning into higher quality stocks, maybe sprinkling in some more defensive equities. But now is the time to think about leaning into high quality bonds, because once those two things happen, spreads blow out and initial claims rise, it's often too late to capture the income that's available in bonds. So you probably remember, down the street from John Hancock, John F. Kennedy once said that the time to repair the roof is when the sun is shining. And we think this is the time to think about emphasizing bonds, before it's too late to get these great yields.
She's going to quote Ted Williams next time she's on.
Exactly. So, Emily, again, we're in the fixed income space. You could sit there at a treasury 2 years, get 3.87%. It's not where we were just a little while ago, north of 4%, but still decent. Or do I take credit risk? How much credit risk should I be taking here?
Yeah, so our favorite areas in terms of, the risk return trade-off right now are investment grade corporate bonds, which are yielding, 4 to 5%. And I'm talking about like a single A investment grade corporate bond. That's very elevated versus history. We like areas like agency mortgage-backed securities, which are also, showing solid fundamentals and good valuations there. Even treasuries. High yield's tricky. When you go down the credit spectrum right now with spreads as contained, as tight as they are, historically, when spreads have been at this level of around 300 basis points, your 12-month forward-looking return is around 0 to 1%, with a range of positive 10% to negative 10%. To us, the risks aren't worth it there. And by the way, you don't even need to go down the credit spectrum in order to generate an elevated yield right now, which we think is pretty exciting.
Emily, thank you so much. Emily Roland with an important update, Co-Chief Investment Strategist, John Hancock. People go, how do I do it? They were asking me. I had to sign autographs and all that yesterday. I said, it's all because of John Tucker. Because John Tucker taught me everything he knows. It was great. And with Win Thin, it's the same way. Audrey Child Freeman was in tears.
Yep.
In London, she goes, Win's on after me?
Exactly.
We're going from Audrey Child Freeman to Win Thin. That's very cool. He was a great mentor to Audrey years ago. Dr. Thin, thank you so much for joining from Brown Brothers Harriman. When I don't want to redux, like what's the Euro call at Brown Brothers Harriman, I want to take your just high ownership of Pacific Rim Dynamics. What does a China slowdown mean for Burma? What does it mean for Singapore? What does it mean for Vietnam and up to Japan?
Well, first of all, Tom and Paul, thanks for having me. It's always a pleasure. And Audrey is a tough act to follow. I miss working with her. She's a pleasure to work with. And you guys lucked out in landing her. To me, the China story is just bubbling in the background. I mean, we have some headlines here and there. But when you look through all the noise, the fact of the matter is they really haven't done much to address the underlying problem, which is a huge debt overhang. Debt to GDP is almost 300%. They've tweaked policy. They're pushing on a string right now and trying to support the housing market. But to me, it's a net negative in a sense for a lot of the export-oriented countries such as Singapore, Taiwan. But at the same time, it's a slowing China and sort of a rotation out of China is a net benefit for some of its rivals such as India, Vietnam, and other countries that are sort of picking up the nearshoring, the friendshoring. So it's a mixed bag. But I think in general, the world has to come to grips with the fact that China is growing 2-3%, at most, I think, and it's going to continue to struggle. Can you be long Pacific Rim? Can you be long as a talking point Vietnam? Absolutely. For instance, you mentioned Vietnam. It's one of the beneficiaries of the friendshoring. India is another one of them. But even the countries such as Korea, Taiwan, Singapore, they have great fundamentals. They still have a solid manufacturing base. They're the source of a lot of the world's chips. So there is still great stories there. It's just that much of the growth in EM over the last 10, 20 years was really driven by China growing 10%. And that sort of turbocharged it. But again, we're sort of in a new normal. but that doesn't mean these countries can't continue to prosper. Again, fundamentally, story in the Pacific Rim remains very strong, ex-China, but it's a new normal.
So when, I guess most of our audience just knows, as you mentioned earlier, that much of the growth coming out of Asia has been China. How about the next 5 to 10 years? I can't imagine that they're going to be comfortable with low single-digit kind of growth in their economy. Is there any way they can turbocharge that, or is their issues just too fundamental?
No. I think many of the countries in that region have been very much export-driven, right? China was growing, the U.S. was growing, everyone's consuming, but we're seeing sort of cooling of global growth, post Great Financial Crisis and now post-pandemic. I would say many of these countries are going to try and sort of rotate out of being so export-oriented and try and be more domestically oriented, to encourage domestic consumption, domestic prosperity. China's trying to mix the bag, given this huge debt overhang. But I think other countries will start to look a little bit more inward, and in a sense that they have to. Again, we're out of this old world where China was growing 10% and they could just chug and export growth and export their way to prosperity. It's just a new normal. I think they can continue to prosper, but we have to see this rotation away from export orientation, totally. Of course, they'll still export, but more towards domestic consumption.
How consistent do you believe the Bank of Japan will be in kind of trying to raise rates in that country, support the currency? How consistent can they be, do you believe?
Yeah, so I know you spent I cut the tail end of your conversation with Audrey. I know you spent a little time on it, so I won't sort of regurgitate, but I do agree that with Audrey that they've been able to prevent a huge major market meltdown. Yeah, we had that scare a couple of weeks ago, but here we are back at the highs with equities, currencies are stabilizing, so they're managing. I think the bone I would have to pick with the Bank of Japan is they actually admitted, hey, we're on hold because of the market. And I've seen editorials on your page as well. I think Mr. Arian and others. Is that the central banks can't always be led by the market. It's sort of the tail. It's wag the dog, right? The central banks, Bank of Japan, the Fed, they have to lead the markets. And so far, for instance, if you look at the U.S., the Fed has done a fantastic job. The market's been wrong about the easing cycle. I don't know. I've lost count. I used up all my fingers. But I think that's the story. That the central banks have to be the one that set the theme. And so I was a little disappointed that the Bank of Japan sort of blinked. Right. But they will continue to be very, very cautious. Remember, the last 2 times they've hiked, they've gone into recession. So I don't blame them for being cautious. But I'm a little, I think they should have stood a little bit stronger.
When there are tentative meetings, an orchestrated ballet between the United States of America and China involving Jake Sullivan, this has been in the news in the last couple of days, folks, and one of the themes there, obviously Taiwan is front and center, but one of the themes is the South China Sea. I think maybe more than anyone we talk to, Dr. Thin, you've lived it. How do we have confidence in investment in the Pacific Rim when we've got ships bumping into each other in the South China Sea?
Yeah, Tom, that to me is like one of the sort of age-old dilemmas as any kind of market strategist. How do you really position for sort of these black swan events, tail risk events on a political sphere? It's difficult. I would sort of point out the fact that we are basically running 2 ground wars in Europe and Middle East with the risk of maybe 3 and 4, and yet the markets are sort of overlooking it. So yeah, I think with political noise, it's always there. I don't mean to diminish it, Tom. I mean, it's a serious risk. But if you're an investor, if you're a multinational, a portfolio manager, you sort of have to look through it and really just kind of cross your fingers and hope for the best. So to me, China is provoking. There's no doubt about it. We've had some as you point out, ships bumping in the Philippines. Right. They had an unprecedented incursion into Japan airspace. I think it was the first time it's been confirmed. I think they're provoking. What I worry about, and I always worry, is something accidental happen. Something. I don't think China's looking to really cause any kind of major conflagration in the area. They are provoking, but what if something accidentally happens where a plane goes down or something? That's what I worry about. And so, to me, I wish that everyone would sort of dial back. But I think unfortunately we're far from that. But,
Winston, thank you so much. Greatly appreciated. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.